Sometimes a single new rule can cause massive waves, and that's exactly what's about to happen in India's huge derivatives market. Today, we're going to break down a major regulatory shift that's all about money, risk, and, well, what happens when the party's over.
So, let's get right into it. We're talking about the end of an era, really. The era of what everyone calls cheap leverage. And to get a real feel for what's at stake here, let me paint you a picture. Okay, so just imagine for a second. You're running a trading firm, and not just any firm, a really successful one, right in the heart of India, one of the busiest markets on the planet. Now, your whole business model, it's built on borrowed money. You go to a bank, you take out a big loan, let's say 100 crore rupees, and you use that cash to trade in the derivatives market. That's called leverage, and it's been the engine for your profits. And you know what? Business is booming. It's working perfectly. And then, bam, it feels like it comes out of nowhere. You hear about this new rule, and it's not some vague guideline. It's got a hard deadline, April 1st, 2026. And you realize this is going to change literally everything about how you operate. And here's the bottom line. The party, it's over. That easy, cheap money that your entire strategy was built on, well, it's about to dry up. We're talking about a single rule that could send shockwaves through the whole system. So you're probably asking, how exactly does this all work? Let's get into the nitty-gritty, the before and after, to see what the real impact is, and who's going to feel it the most.
All right, so the main players caught in the middle of all this are what we call proprietary trading firms. Just think of them as the engines of the market, right? They're using a mix of their own cash and borrowed money to trade like all day long. And all that activity, it provides liquidity, which is basically the lifeblood that keeps the market moving smoothly. So yeah, they're a pretty big deal.
Okay, so this is where the rubber meets the road. Under the old rules, it was pretty simple. A bank could lend you 100 crore without having to set aside a full 100 crore of its own capital. That's what made the loan cheap. But the new rule, it completely flips the script. Starting in 2026, if a bank wants to lend out 100 crore, it has to hold 100 crore in capital against it, 1-to-1. And that makes lending way more expensive for the bank, a cost they're definitely going to pass on to you, the borrower. And the impact of that in the real world? It's huge. Just look at this example. A trading firm's power, its ability to trade, could get sliced almost in half. Why? Because banks just aren't going to lend as much when it's so expensive for them to do so. And when there's less borrowed money floating around, well, that means a lot less firepower in the market. Okay, so this brings up a really obvious question, right? Why on earth would regulators do something that could slow down the market so much? And the answer, in one word, is stability.
You have to see this from the regulator's point of view. They're playing the long game here. They're trying to lower the risk of a total market meltdown, make sure the banks are super stable, and stop those crazy speculative bubbles that cheap money always seems to create. Think of it as a preemptive strike, trying to stop a crisis before it even starts.
And if you're looking for a reason why they're so worried, just cast your mind back to 2008, the global financial crisis. That was the ultimate cautionary tale of what happens when too much leverage goes wrong and blows up the system. So when Indian regulators look at their own red-hot derivatives market, you can bet they're doing everything they can to make sure that history does not repeat itself on their watch.
Now, a big change like this is never just about one group of people. It's like dropping a stone in a pond. The ripples spread out everywhere. So let's talk about who else is going to get hit by this.
Okay, so first up, obviously, are the trading firms themselves. Their entire business model gets put in a vice. Then you've got the banks, who are going to make a lot less money on these kinds of loans. But here's the kicker. The group that gets hit indirectly is regular people, retail traders. See, with the big players trading less, the market itself can become less liquid. And what does that mean? Well, it could mean bigger, sharper price swings. And it might just get a little bit harder for everybody to get a fair price when they buy or sell.
And we're not just talking hypotheticals here. Some analysts are actually putting a number on it. They think that market volumes, the total amount of trading, could fall by as much as 20%. 20%. That is a serious cooldown for a market that's been one of the hottest in the entire world.
But there's always a potential downside, an unintended consequence. What happens if trading in India just gets too expensive? Well, what's to stop these big trading firms from just packing up and moving their operations offshore? Think places like Singapore or Dubai, where the rules might be lighter. India could actually end up losing all that business, and maybe for good.
So, when you boil it all down, what we're really looking at is a classic trade-off. It's that age-old dilemma, a little bit of pain in the short term for the promise of a much bigger gain in the long run.
And you can see that trade-off right here.
In the short-term pain column, you've got the obvious stuff: lower trading volumes, traders making less money. Not great. But then you look at the long-term gain side. That's what the regulators are betting on. They're hoping for a healthier, more stable market, one that isn't always on the verge of a crisis. They're aiming for sustainable growth that lasts.
There was this one analogy from the source material that I think just nails it. It said to think of this as regulators removing market steroids from the system. I love that. You might not get that crazy, explosive growth that makes all the headlines, but what you get instead is something real, something stronger, more organic, and way more sustainable.
And that really brings us to the final multi-billion-dollar question. Is this move going to slam the brakes on one of the most exciting markets in the world? Or is it a brilliant move to manage risk, one that's building a foundation that's actually stronger for the future? One thing's for sure, the cheap leverage party is officially ending. And what happens next? Well, you can bet the entire financial world will be watching.